Today we're going to talk about the difference between a seller's and a buyer's market. And a lot of you guys know I did a video called Pencils Down. So what are the signs between a seller and a buyer market? When do you buy and how long do you wait? Stick around because we're going to talk about what I think is going to happen through the rest of this year. So many of you know that a seller's market is simply when demand exceeds supply, and that's what we just came out of. Prices are going up and there's bidding wars, and days on the market, which is how long it takes a property to sell from the time it was listed, are all super low, and prices are going up, then typically that's considered a seller's market. Although there are lots of other factors that contribute to a seller's market, those are the top three. So on the other side of that, of course, what is a buyer's market? That, of course, is when supply exceeds demand. So simply, when prices are going down, days on the market are longer, and listings are going up. So let's break this down a little bit further. In a seller's market, prices are going up, listings are actually going down because they're selling very quickly, and days on the market are actually super low. In a buyer's market, prices are going to be going down, listings are going to be going up, and days on the market is also going to be going up. So now let's take a look at the data from 2021 and 2022 as it relates to why it was a seller's market. Specifically in three different categories: prices, listings, and days on market. In the first chart right here from the St. Louis Fed, you can see that we peaked in the third quarter of 2022 at $468,000 as a median price across the United States. So the next chart here for listings is, of course, the active listing count in the United States. And why is this important? It's because it shows exactly how many homes are listed in the United States at any given time. From looking at the chart, you can see that we peaked in November of 2022 at 751,000 homes. What I really want you to look at is right here, when you can see in the first quarter of 2022, we hit an all-time low of 351,000 homes, as reflected going clear back to 2017. So the real question is, why did listings go down from November of 2022 to now? The reason is, of course, that many of these people that would have normally listed their homes during a time of low interest rates are now facing a 6% interest rate if they sell and buy another home. The third chart, also from the Federal Reserve of St. Louis, shows days on market. Of course, this is just median days on market in the United States for all markets. Now, this is the chart that I think is one of the most compelling. Why is this important here? Because you'll see that the days on market is reflective of how quickly homes are selling. And it has not been this low going clear back to 2017. I would argue and say that these areas here are actually more healthy for the real estate market than this right here. So now let's take a look at February 2023 current day. As you can see, we have prices, listings, and days on market. But according to the Federal Reserve's own website, you can see that the prices nationally have not moved down that much. Many of you know this. Some markets are really down, but others are up. But generally, prices have not reduced that much. Two, you can see that the active listings have also gone down as a result of these higher interest rates. People are holding back and deciding not to list and just stay put. There's actually less inventory than there was just a few months ago. The third category, days on market, you can see went up and is now sitting at 75. That means if you list your home today, it takes about 2.5 months to sell it. If you go back and take a look at this chart, you can see that it goes from 2 months to 3 months over a longer period of time. So this is more normal than what we just came out of. So many of you know that I like to do my little procession chart. So what I've done here is I've said, okay, we peaked at the seller's market in July of 2022. This period here in the center represents March of 2022. And of course, we've had 8 federal funds increases, which have increased mortgage rates during this period of time pretty dramatically. Looking back, you can see that we've increased rates about 3%, basically doubling them, and created another $1,000 a month for any potential buyers. And that is why things have slowed down. Inflation has come down, but it's still high as the Federal Reserve continues to battle that, as evidenced by the 8 federal funds increases going back from March of 2022. Some good news or bad news, depending on who you are, employment numbers are actually up. So we have a low employment rate and high employment numbers as reported in January of 2023. Why is that bad, you might ask? Because the Federal Reserve, believe it or not, is trying to grow the unemployment rate because they believe too much employment is going to drive higher wages, and we could get into a wage price spiral issue, which could potentially create more rate increases, which is not what we want because that, of course, is going to drive real estate prices lower. What we do know is days on market has more than doubled in just a few months. So what does all this mean? Where are we heading? And what do I think is going to happen for the remaining 2023? Here we are in 2023, and many home markets have gone down significantly, but many have gone up. But nationally, prices have not gone down that much. The listings are down as a result of having trapped equity. People aren't listing their homes because they're waiting and seeing what's going to happen next. And of course, days on market is up. So what do I think is going to happen next? One, I do believe the Federal Reserve is going to come out with more interest rate increases, as much as 3 or 4 in 2023, as inflation rate is still over 6%. Unemployment is still very low, which is inflationary. So I believe the Federal Reserve is going to continue to increase interest rates, which will affect home prices and drive them down further. Prices have really not gone down that much after 8 federal funds increases. I believe there's still a little bit of lag, and I still believe the prices are going to continue to come down. 2, listings are also down because many buyers are sitting on this 3 and 4% interest rate, and they're not going to sell their home only to buy another home comparable at 2 or 3% higher than they have currently. 3, of course, days on market has more than doubled, and I do believe that that's going to continue. So the number one factor in all of this is what the Federal Reserve is going to do in 2023. So I believe the Federal Reserve is going to have to increase interest rates at least 3 or 4 more times this year to combat some of these wage spiral issues that they have with high employment numbers. The inflation rate is still well over 6, as we all know. So I believe that's going to hit, and what's going to happen is prices are going to continue to erode because we will have a lag effect, which I've talked about in some of my other videos. The wild card in all of this are listings, because if I'm a buyer with a 3% interest rate, I'm not listing. There's no way I'm going to replace my home only to pay a significantly higher interest rate to buy the same type of home. All of this is going to continue to drive the days on market even higher. By putting my team back on the field, I'm going to tell them by the end of the year, we're only still going to be in the 5th or 6th inning because the Federal Reserve is going to continue to raise their interest rates. Prices are going to continue to go down. Days on market is going to continue to go up. I do believe listings will creep up a little bit, but not that dramatic, because there'll be a lot of people that'll be sitting on these low interest rates that are going to say, there's no way I'm going to sell my house only to trade it out for a higher mortgage payment later.